Good morning and welcome to the CT Private Equity Trust PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. And I'd now like to hand you over to Hamish Mayer, Fund Manager. Good morning, sir.
Good morning, and thank you everybody for joining this presentation. We're going to cover the full year results for CT Private Equity Trust, the results for 2023. That will include giving you the fourth quarter's NAV and looking back at recent developments in the company. I've got this presentation, which is in a familiar format. I'll take you through that, and then hopefully we'll have plenty of time for questions at the end. So in terms of the highlights for the year, we've recorded a positive return for 2023 of plus 2.8% and an NAV total return. We had a positive return in the final quarter of 1.9%. We basically had a slight adverse impact of exchange rate movements during the year, which probably took about 2% off the NAV, so it would have been 4.8% without that. To put this in context, this comes after a number of really strong years, and I think we had always been anticipating that there would be a bit of a year of adjustment in 2023. And in that context, we're pleased to have recorded a clear positive return. The dividend is kept at 7.01 pence, and that gives quite a handsome yield on the current share price. Currently have just under 45% of the portfolio is in co-investments, direct investments in private companies, and that has been sort of gradually moving up. Obviously, as investments are realized, we have to build up with new ones, but this is very much in line with where we expected it to be. Just a couple of new investments were made in the fourth quarter of last year. We committed 4 million euros to a new Spanish lower mid-market fund, Orica, and we've been tracking them for a number of years, so that was a natural thing to do. And we've also done a co-investment actually with that manager, Orica, in Educa EdTech, which is a Spanish e-learning business that provides master's degree courses and other things like that, mainly to the Spanish-speaking world, and that's a growth market. We've got some more detail on that, which I'll take you through in a minute, and that was 4 million euros. This is the long-term picture, one of good progress. You can see the cumulative dividends. We introduced the current dividend policy back in 2012, so it's very well established. So that essentially means that we pay out 4% of NAV a year as dividend, and it's a upwards only dividend policy. Just to remind you, the dividend is paid out quarterly, and the quarterly payment equals 1% of the average of the previous 4 quarters NAV. And should that number come up with a number that is lower than the previous dividend, we just maintain the previous dividend. So it's a system where the dividend will track closely the growth in NAV, but it will not go down. And people tend to find that pretty attractive and helpful. This is the longer term picture. The company has just celebrated 25 years, its 25th anniversary. That was on the 22nd of March. I've been involved all the way through, and you can see this is the long-term return both of NAV and share price. There's a bit of a gap between the two, but there isn't always a gap, so I think that's an opportunity. We've basically delivered double the return per annum of the stock market over that 25-year period, and actually if you add up all the gains, including dividends, from investing in our shares and compare it to what you could have achieved in the stock market, it's far, far greater. So in other words, the gains are nearly 12 times the original investment over that 25-year period for our shares. And if you had invested just in the all share index over that same period, you would have made 2.4 times your original investment. So a much greater return, which I think underlines the benefits of private equity investment over the long term. You've made me making that argument before, and I'll make it again. It is a riskier asset class, but if you stick with it over the long term, you are handsomely compensated for taking that extra risk, and we are just one example of that. Just another way of looking at the returns, you can see we last year, or in 2022 rather, we were just under 15% total return, 35.8 the year before, 22.7 the year before that, nearly 11% the year before that. So this modest return in 2023 is in the context of some very strong returns in prior years, and I'm hopeful that we will resume that kind of record in the current year. In terms of outstanding undrawn commitments, these are basically well within the normal range at just 209 million, of which 26 million is unlikely to be drawn. This is 41% of net assets, which is very much in line with the last 5-year average. In terms of debt, debt has gone up a bit, which is basically a function of realisations having gone down significantly during the year, but we've got plenty of borrowing capacity there, and we're still very much within the normal sort of comfortable range of gearing. We do believe in having this company geared because it's a very broad portfolio against which people are quite happy to lend, and we expect to make returns which are far in excess of the cost of borrowing from the investments, and we still believe that even with the effective cost of borrowing having doubled during the year. We basically renewed and extended our borrowing facility in February. So we have it was due to expire in June, but we usually replace it with several months leeway. And so we've got a new 3-year facility in place, which is bigger than the previous one. It's 35 million euros bigger. So that's on the term loan, and the revolving credit facility remains at 95 million. So it's basically an increase in the size of the borrowing facility by about a quarter. And that's, it gives us plenty of headroom. We've also tweaked the covenants a little bit, which are basically balance out as better for us than the previous covenant. And there's also an option of increasing both the length and size of the facility with the bank's consent as we get towards the end of its life, which is something that they have asked to be built into the documentation, which we find quite useful. The margin is slightly higher than it was before, but funnily enough, the non-utilization fee is actually lower, so it's very similar in terms of the cost to us in terms of margin. So we're well placed to take advantage of any opportunities that we come across. Number of new investments were made during 2023. I'm not going to go through all of these individually. I will talk about some of the co-investments, the more recent new co-investments in a moment. But the point is that these investments are, very diverse. There are lots of different sectors, different geographies, different lead managers. There's quite a strong technology emphasis. Quite a lot of healthcare as well, and some which are both healthcare and technology, as well as other more, prosaic sectors. And it is deliberate that we have such a diverse portfolio. This is one of the innate strengths of the company, and that is being reinforced all the time as new investments go into the portfolio. So these have continued on. These are just a few of the other ones. And we've made a couple of new investments in 2024 so far. We've committed to Corin Environmental Fund 2. So this is a fund that focuses on clean energy and environmental companies. The first investment is a large company called Vital, which is a district heating company, which also has a big waste to energy plant. Now, we know the team at Corin extremely well. It's run by Gary Lasser, who was a partner at SEP and ran their environmental energies fund. And I've known Gary for about 25 years. And then we've also backed the Agilitas Human Investment Fund. So this is an impact fund investing in areas of need, but with a fully commercial target return. This is led by Martin Calderbank, who I have known also for probably about 25 years, probably more than that actually, 30 years more like. And he has delivered for us in several formats, both funds and co-investments before, and I'm pretty confident he'll continue to do that. Just in terms of the more recent co-investments, I know some of you have heard about some of these already, so I won't labor them, but I will just give a couple of highlights of each of them. So StarTrack is an August equity deal. This is a software company that makes software for essentially speed cameras. So processes speeding tickets, but it also has new applications such as catching people who are using their mobile phones with their hands whilst driving, which is illegal. They have a client base which consists of a large number of police forces in the UK, but they're also expanding overseas. I mean, they didn't really proactively expand overseas, although they did have a number of customers, and that's an area of growth for them. And this is going well, actually. It started off strongly. The second one is also an August equity company. It's also software, but completely different sector. This is called One Touch. So this provides software to the care sector. So basically, it's a system which can be used both by the company itself in terms of managing its workforce and making sure that the care plans are being followed properly, managing the time and who is going where when, and also can be used by the clients or the family of the clients via an app, so they can see who's coming in when, for how long, all that sort of thing. It sounds all quite commonsensical, but nobody has actually produced a system which is as comprehensive and user-friendly as this so far. The company started in Ireland. It's moved quite strongly into the UK, and it is doing very well. That's also got off to a good start. Next one is Cardo Group. So this is a totally different company. It basically refurbishes social housing, makes them more energy efficient, more sort of environmental things like heat pumps and insulation, as well as other things just like redoing the kitchens. This is a Wales-based company. It's growing rapidly into the adjacent part of England. It's led by a young, very capable entrepreneur. And this deal is backed by Buckthorn, who are specialists in energy transition and with whom we've done a number of deals already. And that also seems to have got off to a good start. Next one is Cyclomedia, completely different. There's a technology aspect to this one. This is basically it basically provides geospatial data, maps, areas of buildings, and these maps, these software maps, are used by the end clients for the purposes of local taxation. So rates and other types of property-based taxation. It's started in the Netherlands, has moved into Germany and into the United States. The deal is led by Volpe, whom we've been invested with for a number of years, and we've actually known this company for several years as well. And there's still plenty to go for. So we're optimistic as to how this will develop. Then Utamaco, which is a cyber security and data intelligence company. What they do is they basically make these tamper-proof security tokens and other things like that. It's a German company. It's already got a large blue chip client base. This market is growing quite strongly, double-digit growth, which is all to do with the prevalence of cyber crime and other forms of sort of technology-based crime. So people do need this. Led by SGT, which is a German lower mid-market specialist that we've got to know over recent years. And then this is one which I actually had mentioned in the third quarter presentation, but I wasn't allowed to tell you what the name was because it was still secret at that time. It's called BrainCube. So BrainCube is an industrial software provider to the manufacturing sector. So it's so-called industrial Internet of Things platform. So their software collects all sorts of data from manufacturing processes, which is then fed back to the clients and allows them to analyze and tweak their processes, maximizing efficiency, reducing waste, reducing energy consumption, all these kind of things. Again, this business already has quite a decent client base, some really good blue chip companies. It's based in France, in Issoire, which is in central France. And the deal lead on this is Scottish Equity Partners, whom I have been backing since 1996. And we've done well with them, both in funds and co-investments. So again, optimistic about how this will take off. And then Educa EdTech, I mentioned briefly before. So this is, they basically have this suite of products which allow people to learn online at their own pace, with quite detailed courses, master's degrees and other types of sort of higher education. It's very, it's a very user-friendly setup they've got. It started in Spain. Their main market is the Spanish-speaking world, which, as you can imagine, is quite large, including the whole of Latin America and actually parts of the United States. And this is growing quite rapidly, and we managed to get into this for really quite a low price. The effective in price is below 7 times EV to EBITDA. So for a business of this type, that is a very attractive in price. And this is led by Orica, the Spanish mid-market specialists. We've had plenty of realizations during 2023, although in terms of the quantum, it's down about 50% on the previous year, which was a near record year. It wasn't the absolute record, but it was the second highest year we'd ever had. So we had expected that there would be a decrease in realizations this year. But the ones that have been achieved are basically at good prices, and it's very broad in terms of the geography, sectors, lead managers, and that has continued through the year. I've got some more information about the exits in a minute, and they've continued into the current year also. Plenty of new drawdowns. This is just part of rejuvenating the portfolio with new deals, providing the foundation for future growth. And these have continued. I'm not talking through all the individual ones, but you can get a sense just by looking at that list of how heterogeneous the portfolio is. This is just a long-term pattern of distributions and drawdowns. It obviously fluctuates. There are some periods that are much more active than others, but there's always something happening. And then the largest underlying holdings, just to give you a quick update on key events or likely events. Now, Jolly's has actually been sold, so it was in the portfolio at the end of December 2023. But in February, Kester, the lead manager, agreed to sell it to TDR Capital. So it's held at its takeout value. We've actually now got the money. and it was the 3.9 times money, 29% IRR. This is a pet shop chain. It's a bit like a smaller version of Pets at Home. It's the second largest large format pet retailer in the UK, and Kester have done a really good job here. The company did well through COVID when everybody went out and bought a dog. Well, everybody except for me, but a lot of people did. And they've actually doubled the size of the chain over the holding period, and we've obviously made nearly 4 times our money on it. So that's a great outcome. It shows you that you can this type of thing is still perfectly achievable, albeit we've had a more challenging exit market recently. Sigma is still in a kind of rather drawn out preparation for sale. So hopefully something will happen there later this year. Coretrax has also agreed to be sold, so we haven't had the money yet, but the deal with Expro has been signed. So we're expecting to get up to half of that consideration in cash, maybe slightly less than half, and the rest will be in Expro shares, which will be sold down gradually. This is a buckthorn lead, and that's what they did with Ashtead, which actually worked out quite well for us. TWMA is another buckthorn one. We will probably have an exit on this towards the end of this year. Fundamentally, it's trading quite well, but multiples in that sector have come down a bit. We're just waiting for their big contracts in the Middle East to kick in, and then we'll be able to sell probably at a higher price on the back of those. This is a company which did suffer a bit during COVID because people couldn't actually, they're difficult getting people out to the rigs and all that sort of thing. The fifth one here is ATEC. It's an insurance company. It insures little caravans and small boats, and that has done well in quite a challenging sector, but it has done really well. So we're looking forward to exiting this probably later in the year. Funeral homes business, Sansira. This is the remnant position. If you remember, we've already exited 3/4 of this at about 8 or 9 times money, but that still remains a significant holding for us. Weirdfish, you've all heard of Weirdfish, our clothing company. That's had a bit of a roller coaster ride, but we're actually up at the moment. It actually had a very strong finish to last year, and they've put in place a new chief executive who's got some ambitious plans, which are pretty credible given that the new chief executive used to run Crew Clothing, which is directly comparable, slightly bigger business. So we're optimistic about how that will develop. Payments company Aurora continues to make progress. It's still quite early in the deal. Cyclomedia, as I've just mentioned, has just gone into the portfolio. And Amethyst, which is a chain of radiotherapy clinics, is doing well. So there's quite a few things just to watch out for there, and which essentially bode reasonably well for 2024. In terms of the statistics of the companies, now this covers the co-investment portfolio, which is just under half the portfolio, but I think is representative, broadly representative of the overall portfolio. So you can see that we're talking about businesses which are very much lower mid-market. So average revenue, 63 million pounds, average EBITDA, 11 million roughly. So not the corner shop, but not a sort of behemoth either. They have got good growth in revenue in 2023 of 17%, which is quite strong, I think, if you consider what the general economic and market background has been, and even stronger growth in EBITDA, which is essentially the cash flow. So I've said in my statement that we think the underlying fundamentals are strong, and that's based on these statistics which prove it. In terms of the number of underlying holdings, in a slight increase during the year, just over 500. There were 51 exits, 70 new companies. When companies are sold, they're typically sold at a premium to the immediate prior carrying value, and that was very much the case this year. They were on average held at 2.4 times money and sold at 3 times, which is a 29% uplift on exit, which is pretty close to the long-term average. The weighted average uplift is a bit higher, 36%, and it was quite a bit higher last year at 70%, because we benefited from the exit of San Siro, which was quite large, and that was a sort of 8 times exit, which was quite a lot in excess of its immediate carrying value. But the general picture is that when companies exit, they exit well, and it does, all things being equal, boost the net asset value. The thing is, all things are not always equal, but it is worth tracking closely the realizations and the premiums achieved on realization. The exits by exit route haven't changed that much. 60% were sold to other private equity firms, 40% to trade sale. So that's slightly more to private equity than the sort of average, but not much different. There was quite a few so-called exits to continuation vehicles. So that's where you're selling to private equity, but it's the same private equity house which sets up a new vehicle, sometimes with the same or similar investors, sometimes with new investors. So you could say it's selling to yourself, but there's always somebody in there determining the arm's length price. And of the private equity sponsor exits, about 22% were to continuation vehicles. In the previous year, there were none to continuation vehicles, so you'll probably have read about this in the papers. The key thing is that you have the option to continue or the option to come out for cash, and if the cash option is attractive enough, we will generally take it. It is normally a safe thing to do to stay in a continuation vehicle, because the private equity sponsor obviously already knows the company inside out, and they wouldn't be continuing if they didn't think there was worthwhile upside still to go. In terms of the exits by geography, well, it's not that dissimilar to the overall pattern of the portfolio, with just under 40% in the UK, most of the rest in continental Europe. In terms of the actual looking at the portfolio as it is well diversified by geography and vintage year, as it always is. There haven't been a big change in the proportions: 42% UK, 17% America, basically the rest in continental Europe. And in terms of vintage year, half the portfolio is more than 4 years old, 60% over 3 years old. Essentially, the investment thesis per investment is usually based around a 4-year hold. And so therefore, when you're 3 or 4 years into the deal, if things have gone according to plan, you're basically preparing the company for sale, and this will result in an exit before long. So it's a measure of the maturity of the portfolio, and therefore of the possibility of a decent flow of exits. In terms of its rating, on a weighted average holding on an EV to EBITDA basis, it's 11 times, which is above the entry level of 8.7 times. So there's obviously a bit of multiple improvement there. When we invest, we don't assume there will be multiple improvement. It just it happens as the companies get bigger and more attractive. And the debt level is not high. It's 3.1 times. Excuse me. This is the underlying level of debt in the portfolio companies. So in a new deal, you start with a higher level of debt, but it reduces as we go through the holding period. And obviously, the gearing is part of the investment case. It magnifies the growth in EBITDA in terms of the return that we can get as an equity holder. In terms of sectoral split, this hasn't changed particularly over the year. Still got nearly half the portfolio in a combination of healthcare and information technology. These are sectors that private equity is interested in for fairly well-known reasons, secular growth, increasing digitalization of the economy, technological advancement in all sorts of different spheres, providing great investment opportunities. But we've also got plenty of more standard sectors represented, business services and consumers as well. So just to conclude and to look forward, I mean, the company has proved resilient over the years. We've delivered a positive return this year. To some extent, it has been a bit of a year of adjustment, but we're well placed. We've put our new borrowing arrangements in place, which gives us plenty of capacity. We've got this good exposure in these long-term sectors delivering secular growth. We see excellent deal flow, both in terms of funds and co-investments, and we, selectively take advantage of that. Realizations were down by 50%, but the ones that have happened have achieved good returns, and we actually are seeing some good signs of recovery in terms of realization quantums and number as we've had the first quarter of 2024. And the average uplift on the exits has remained at a very healthy level. People are generally positive on private equity for the long term. I think some people probably over-committed in the last couple of years, and so they've been committing slightly less during 2023, but that will work its way through the system. And, people are generally committed to private equity over the long term. And we remain confident that we'll be able to continue to grow shareholder value. We've done so for the last 25 years, and we hope to continue that into the foreseeable future. So that is the end of the presentation. There are some appendices in here, but I think this is probably time for me to take the questions.
Perfect. Hamish, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab, which is situated on the top right-hand corner of your screen. But just while Hamish takes a few moments to review those questions that have been submitted today, I'd like to remind you that the recording of this presentation will be available, and a copy of the slides from your investor dashboard. As you can see, we have received a number of questions throughout today's presentation. And Hamish, if I could just ask you to read out those questions and give responses where it's appropriate to do so, I'll pick up from you at the end.
Okay, right. The first pre-submitted question is, Hamish, I've invested in the trust for several years, but I'm showing a capital loss. Appreciate we get a reasonable yield, but it would be good to see some capital appreciation as well. I know you feel the portfolio is sound. Why does the market not recognize it? Is it maybe time the board started buying back the shares or look for a takeover of the company at near asset value? Okay, well, I mean, actually, there has been significant capital appreciation. If I just illustrate this, looking at the slide, so you can see that's the NAV, which is the dark blue. So that is actually on a rising trend. So I would say, stick with it. You will get capital gain. I think you're probably referring to the fact that there's quite a big discount to NAV. Well, this obviously fluctuates, and we think it's, unjustifiably wide at the moment. That provides a buying opportunity. I'm pretty confident it will narrow. What typically happens is that when the market is feeling sort of risk, averse, and it's in a risk off mode, the discounts tend to widen. It's not just ours, it's the whole sector. And when they're feeling a bit more optimistic, the discounts tend to narrow. And that is almost irrespective of the fundamentals of what's going on in our portfolio, which is a bit frustrating. But if you can accumulate whilst the discount is wide and wait for that change in the market, and we will obviously do everything we can to change that perception, then you could do pretty well. We do buy back shares, and in fact, we just bought back 1 million, and we did that on Friday at £4.60. So that enhances the NAV. It's not a silver bullet for the share price, but where we have capacity and the stock is available, then we will do it. And we're not going to end up shrinking the company dramatically by doing that. That wouldn't be in anybody's interest. But we will do it occasionally. We've just done that. That proves that. I'm certainly not looking for somebody, or the board certainly isn't looking for somebody to buy back the entire company and sort of cease our existence. I think we do provide a attractive vehicle for a wide range of investors, and I think if we were to disappear, I'm not saying there's absolutely no alternatives, but it would distinctly reduce the degree of investor choice. We are, probably we are the most UK oriented of the fund of funds on the stock market. We've got 44% or 42% in the UK. Most of the others are very international, with a tiny amount invested in the home market. So, I think there would be a significant reduction in investor choice if we disappeared. And that's if you could find somebody to take it over at asset value, which you probably could, but we're in the business of running this as a going concern, not in the business of throwing the towel in prematurely. So that's that one. Next one is, thanks. Can you just explain to beginners the cash flow dynamics if you have 200 million of uncalled commitments, but only 60 million of headroom against your net debt position? How do you meet these? Do you have control over timing? I hope you understand the gist of the question, I guess. Could that 200 million all get called in short order, and do you have do you have to provide it? Well, basically, it's a good question. The 200 million is very diverse. Those commitments are across, literally dozens of funds. So the chances of all of that, or even a large proportion of it being called immediately, are very low. I mean, each of these commitments are commitments to funds who typically have a 4 or 5 year investment period. So we know where they are in their investment period, so we can forecast, not with pinpoint accuracy, but collectively with considerable accuracy, about what the drawdown profile is likely to be, and we will then match that against what our resources are likely to be. So that's resources from realisations, but also using debt. We've been doing this for 25 years. We've never been wrong-footed on it. Doesn't mean we're complacent about it. We do have to monitor this very closely. But essentially, the kind of disaster scenario you're talking about is highly unlikely to happen, has not happened in 25 years. And we have had circumstances which are much more challenging than we're facing at the moment. So I think you can sleep soundly on that point. Next one is, what happens to the dividend is if there is a major downturn and assets fall by a large percentage, presumably the floor cannot be maintained in all circumstances. Well, not in all circumstances, but we set it at a level of which we're confident we can meet under most likely circumstances. I mean, if there was a big fall in assets, we would, provided we've got the capacity to pay the dividend through realisations and debt, we will do so. But we will not pay the dividend if we think that's going to put the company in jeopardy. But as I say, 4% is set at a level that we're sure that we can meet under all feasible circumstances. So I think it's not a guarantee, but I think you can rely pretty strongly on the dividend being maintained and over the long term growing in tandem with the NAV. Next question from David G. Forgive the blunt question. You talking about knowing people for 25, 30 years, but how old are you? And who else manages this fund alongside you in terms of succession planning? Well, I'm 58 next month. I know it's hard to believe, but I am, and I've still got a few years of investment management left in me, despite the fact I've already been doing it for 35 years. But I have a team of 9 people running this portfolio with me to different degrees. I've got some very able deputies. So I don't think any of you should worry that should I decide to retire, and I will do at some point, that the company will be in anything other than extremely competent hands. Okay. Charles A. Thanks for the presentation. Grateful for your views why the share price is so volatile. Yeah, it's partly what I've said before. I wouldn't say the price is actually that volatile over the long term. If we look at the slide, I mean, it's not actually that volatile. It's on a long-term, pretty clear uptrend. It obviously depends on supply and demand for the shares, which depends on, as I've said, the environment, the risk-taking environment in the market. The NAV is not that volatile at all. It's actually goes in a pretty steady movement. We have got a broad shareholder base. A lot of wealth managers and platforms hold the shares. We've got a small number of institutions, most of whom have been very loyal. We basically try and keep everybody informed as closely as we can when there is, material news or to share, but also if people want to know about the company, we're very happy to tell them. Next one is Edward M. Between November and results date in April, no information regarding company. Quite a long time, I think. Maybe you could announce rough guide to NAV monthly as Aberdeen Private Equity do. Yeah, I don't think monthly NAVs are adding a huge amount because we only get underlying valuations every 3 months. So the only thing that would change from month to month would be a small number of updated valuations which hadn't come through by the previous quarter, and also things like exchange rate movements and potentially some realisations. Now, if there were big realisations that had a material impact on the NAV intra-quarter, we will announce those. So what that is, if there's an impact of more than about 2% on the NAV, we will actually announce it. We are under constraints in terms of inside information, ahead of results things. And you're quite right, there is a bit of a gap between November and late March. But we still do presentations. We're still available to update people on the company, although we cannot tell them things that aren't generally available in the public domain. I'm not convinced that monthly NAVs would sufficiently enhance things. Ex-dividend date is the next question. I'll find that in a second. I've got it somewhere. I'll move on to the next one. Gerard H. Are there any conflicts of interest between the trust and other PE funds you manage within CT? And then another question of the number of shares CT Savings Plan own currently. The answer is that there aren't really conflicts of interest because the funds are run in tandem, and we have a rigorous policy of allocating new investments across the funds, and we have transparency between what we tell our board and what we tell the advisory committee of advisory committees of the LP funds. So there aren't really, conflicts of interest, and to the extent there are, they are well managed. Number of shares in the savings plan. I'll just get that for you. It's about 24 million shares out of 72.7 million. That's 30 something percent. I'll just get you the exact 24 divided by 22.7. 33% is in the savings plan. Our next question is, how related are your valuation multiples to listed markets, and what has happened to EBITDA valuation multiples in the PE market in general in the last financial year? In the market in general, they've probably gone down slightly, which is the same as we have. Yes, they are related to what goes on in listed markets. That it's not a simple direct read across, because the listed markets don't have exactly the same sectoral exposures or industry exposures as private equity. So ultimately, each of the private equity valuations will be at least indirectly linked to the valuation placed on similar companies in the listed markets. Now, there are lots of caveats to that: size, growth rates, whether they're a pure play or not. So there is a linkage, but it's not a simple linkage. Next question, John W. Have you noticed a drop in expected revenue growth, EBITDA growth across your portfolio in 23 compared to what you expected at the start of 23, and what do you expect for 2024? To be honest, I thought there would be more of a deceleration in EBITDA growth than there has been. In fact, actually, I'm doing this from memory, but I'm pretty sure that the EBITDA growth last year was in the low 20s rather than the high 20s, so it's actually accelerated. I think for 2024, it's a bit early to tell, but I think we would still deliver strong revenue and EBITDA growth fundamentally in 2024. What do I mean by strong? Well, 15, 20% plus, I would think under most circumstances is pretty good. Andrew M, how would you characterize current investment conditions in the broad PE sector on a temperature scale, hot or cold? Warming up, quite warm, better than lukewarm, and it's improving. Given your exits are to PE or trade, is the health of the IPO market largely irrelevant? It is largely irrelevant. I mean, the health of the IPO market is generally affected by the overall health of the stock market. The overall health of the stock market is not irrelevant. But for exits, it's, even in a very strong year for IPOs, it'd be lucky if there were 10% of the exits went through IPO, and normally it's much lower than that. So it is interesting, and we do keep an eye on it. And ultimately, as I've already mentioned, the value of public companies does have a bearing on the price that people will pay for private companies, but we're not dependent on a strong IPO market for exits, which is just as well, because it opens and shuts very regularly. I mean, many years ago, I used to be a small companies analyst, and you'd have a big rush of IPOs, and then suddenly one would fail and there wouldn't be any IPOs for 18 months, and then they'd come back again. And there's a very high degree of cyclicality there, which is not reflected in exits in private equity generally. John W, how much of the 2018 and prior vintages do you expect to sell this year, and how much of this portfolio is problematic in the sense that target IRRs are not expected to be I think he means be met. I don't know exactly, but we will sell some of that. It's not problematic, that element of the portfolio which still has value. I mean, quite often normally the original thesis hasn't entirely worked out, and sometimes there's been a second or third attempt at things, but that doesn't mean that they're all the living dead or anything like that. You can still make excellent returns from holdings that have been in the portfolio for many years, and the target IRRs will probably not be met, but that doesn't mean that they will be completely inadequate. They can still provide really quite good IRRs. Mid-teens, low 20s is not uncommon for quite an old exit. Anything that is above our cost of capital is acceptable, and even things that are lower than our cost of capital, which is probably about mid-teens, is better than losing money. So it's very much in people's interest to turn things into cash, as quickly as they can, even if the return is, suboptimal, even if it's a negative return. It's better to get 90% of your money back than, nothing. And it's rare for us to get nothing back. It does happen occasionally. It's obviously risky. So I wouldn't regard having a sort of tail of older investments as an indication of any sort of problems as such. Next question, Andrew M. Any pressure on you to commit capital to buybacks? Well, there's a bit of pressure. We discuss this with shareholders all the time, or some shareholders. I say not all the time. Some shareholders occasionally, and we have done buybacks as we did just the other day. I gave quite a detailed coverage of my thoughts on this in the results statement in November. If you want to see my detailed thinking, there is a cost to buying back. The company shrinks, and that capital, although it makes an immediate and certain return in terms of NAV enhancement, it is at the cost of a longer term, multi-year return that capital could deliver if it's deployed into new investments. But obviously, there's a level at which, provided you have the resources, which is quite a big if, it does make sense to buy back. But we're not going to end up buying back huge chunks of the company. You've probably seen our larger competitor, Pantheon, bought back, can't remember the exact percentage, I think it was high single digits. It hasn't actually had a meaningful effect on the share price. So yes, it will have boosted NAV a bit. So it is, as I said earlier, it is not a silver bullet. David, are you getting feedback from your institutional holders that you need to be a bigger trust with greater liquidity? I don't know what that beeping noise was. Did everybody else hear that? Well, we would like to be bigger, and we would like to have greater liquidity. In an ideal world, I would be issuing shares at a premium on a regular basis. But we don't live in an ideal world. We have been on a premium a couple of times in our history, and I sincerely hope we'll get back there. I think there's plenty of ways I could deploy the capital if we could grow the company, use our paper, and as I said, I very much hope we'll be in that position within the not too distant future. Next question, Roger H. Is there any progress at Northern Gritstone? Yes, there is, although there hasn't been that much progress in terms of the NAV. There's lots of new interesting investments going in there, and I think they're doing a good job. Mike P. It's a little disappointing that the company's website doesn't reflect the success of investments. For example, the latest fact sheet dates from November, almost 6 months out of date. Could we not have a monthly fact sheet update, please? Well, this is the same as the question earlier about more frequent information. As I've said, between November and late March, it's the longest period that we don't have a substantial amount of new news to share, and that's partly to do with the timing of the full year results and the audit. And we are looking at the format of the fact sheet. Let's see if we can improve that. There is quite a lot of information in there about the success of investments, and also in this presentation. As I say, if people want to know more about the portfolio and they're sufficiently curious, I am available, all the time to speak to them. Miguel M says some European jurisdictions are lowering the ticket size for PE investment and increasing the level of interest in PE from retail investors. Can you market the fund to European investors? Given the discount to NAV, it seems a good entry point for investors interested in PE exposure. Thanks. Well, you're absolutely right. It's an excellent entry point. It is available in most European jurisdictions. I mean, some of them are more tricky to access than others, but it's just like buying any equity. So if you can buy, it's a fully listed company. So if you're capable of buying overseas investments from Europe, then you should be able to buy this. There was a time when the Germans got very excited about whether they were sort of black or white funds and capital gains tax and various or versus income tax, but actually that was resolved years ago, so there is not a problem in buying in Germany either. Gerard H says, will the 1 million shares bought back be cancelled or held as treasury shares? Answer is they'll be held as treasury shares. Neil B says, on the circa 10% of holdings older than 2016, why is it beneficial to continue to hold this tail versus recycling this capital into newer and potentially higher velocity opportunities? Well, it's not that easy to sell it for a start, and if you were to try and sort of sell it, you would probably, it'd be quite a drawn out process. So you're better to sort of stick with the lead managers, and they are very much incentivized to turn all this into cash as quickly as they possibly can. So there isn't a easily accessible ready market for these older positions at a price close to NAV. So it is generally in our interest and in your interest to stick with it. So Tim M says, showing the NAV price seems like smoke and mirrors. It hasn't increased every year for the last few years. So showing as a performance of investment trusts is a bit misleading. It doesn't surprise me more people are moving towards ETFs. Why not show the share price performance for comparison at the same time? Well, it does go up quite a lot, actually. I think we've got quite a bit of evidence of that. If we go back, the share price total return in 2023 was 17.6%. It actually went down in 2022, but there were quite a few things going on in the market in 2022. But as you can see from the long-term chart here, the light blue line is the share price total return. It does generally go up. So there's nothing smoke and mirrors about it. I mean, it's a straightforward fact that the price at which our shares are traded in the stock market is generally on a rising trend, and it is generally in line with the growth in NAV. So there's nothing smoke and mirrors about it. And I think investing in an investment trust is probably superior to investing in an ETF. I mean, the level of disclosure you're getting from me is far in excess of what you'll be able to get from an ETF, which is ultimately run by a computer, whereas this is being run by humans thinking about what they're doing, not just following momentum. So Gerard H, does the NAV report account for the deferred capital gains tax that is embedded in the unrealized valuations? Now, good question. We don't pay capital gains tax because we're an investment trust. Provided we have investment trust status, we do not pay capital gains tax on our investments. So the answer is no, it does not account for capital gains tax. David I, if secondary private fund valuations are nearer to NAV, is there a possibility of them taking stakes in cheap quoted trusts? There is a possibility of that, but a lot of these secondary private equity people are not skilled investors in the stock market. It's a bit of a unknown country to them. So, I mean, there have been people that have bought big chunks of public companies historically, or it's quite often it's the sort of precursor to them being taken out completely. SVG Capital is one that springs to mind. I think HarbourVest got involved there with their secondaries fund. You'd have to be quite a skilled secondary investor who was very comfortable with the dynamics and foibles of public companies and the and what they had to do in order to build up a stake or act as some kind of agitator. And there aren't that many people who are sufficiently skilled to do that. So, but it's obviously a possibility. Edward M, do you feel Dow Jones overvalued as very high valuations compared to the UK? Probably yes, because I think it has there's a small number of companies that drive it. I'm not an expert on the current constituents of the Dow Jones, but I think most people would say the UK is cheap. So I'd agree with that general sentiment. Scott M, how does the wider industry better explain the benefits of PE to the market? Well, I mean, first of all, I wouldn't listen too much to what's going on, what the FT says about private equity, because they have quite a jaded view about it for some reason. I've never quite understood that. They tend to be quite skeptical about the big private equity firms. We are actually investing in the lower mid market, which I think is a very attractive area. It's a huge, broad market with lots of opportunities that just don't exist in the public markets. The management style, the investment style of private equity is excellent. It's all about alignment of interests, involvement of experts in the companies, and calculated taking of risk, which generally works, and that's why these returns have been delivered, and that's why we are confident we can continue to deliver well. There's a lot of work goes into it, and I think it's an ongoing task of evangelizing for our sector. It's never finished. There are always new people coming in, and there's always more work to do, and it's something which both I and the board of the company spend quite a bit of time thinking about and trying to improve. Gerard H, in general, where is the best risk return opportunity, secondaries or primary, in the current market? Well, when we are investing in new co-investments, we will not buy or invest unless we're sure we can do a net IRR of 25%, and we apply the same yardstick to secondaries. I would say that we see a lot of secondary opportunities, but the vast majority of them do not fit those return requirements. We see lots of co-investments, approximately 10% of which we will execute. So secondaries tend to be a shorter hold, but it's a slightly sort of scrappier market in many respects. So I think each of them have their attractions, and this is why this company is a good investment, because you're essentially buying into a pre-existing portfolio that's being rejuvenated consistently, and once you buy the shares, you can benefit from things that have been in the portfolio for a while. So I would say the answer is actually you should buy shares in a listed private equity investment trust, and this one would be a good one to start with. Okay, I think that's I've actually got through all the questions there. I think
Yeah, Hamish, thank you very much for answering all of those questions from investors. And of course, the company can review all the questions submitted today, and we'll publish those responses on the Investor Meet Company platform. But just before redirecting investors to provide you their feedback, which is particularly important to the company, Hamish, could I just ask you for a few closing comments?
Yes, as I say, 2023 has been a year of adjustment, but it's a year where we've delivered clear positive return. This follows some very strong years. I'm confident looking forward into 2024, given the current environment and the deal flow we're seeing and the exits that we're seeing, that we should be able to deliver a handsome return for investors this year. And the shares are standing at still quite a large discount to NAV, which gives you a very attractive dividend yield. And if we can narrow the discount over the year, you could get a very handsome return. I think you should always approach private equity with a long-term mindset. We've had this company for 25 years. It's done well. There's no reason why it couldn't continue to do well for a further 25 years. So thank you for all your support to date, and thanks for listening today. And I hope to meet as many of you as possible. We have an AGM in May in London, so you're very welcome to attend that. there'll probably be some champagne available because of the 25-year anniversary. So that's another factor to bear in mind. Thanks again, everybody.
Perfect. Hamish, thank you very much for updating investors today. Could I please ask investors not to close the session? It should now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of CT Private Equity Trust PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.